Put everything aside and focus. The data I'm examining right now for Friday's session is unlike anything I've recorded in my years of following this market. Multiple explosive catalysts are aligning on a single trading day. Any one of these elements in isolation would generate notable volatility. All of them colliding simultaneously on Friday produces conditions for a market event that could reshape your portfolio before the weekend begins. I'm not using the word explosive for sensationalism. I'm using it because the documented setup mathematically supports extreme price movement in either direction, and Friday sits squarely in the firing line. Before I walk you through precisely why Friday could be devastating for unprepared traders, let me lay out my principles clearly. I will never request your money. No paid signals, no programs, no mentorship offerings, no premium memberships, no investment partnerships, no paid communities. If anyone reaches out claiming to represent this channel and asks for payment of any kind, that's a scheme built to exploit the trust this community has established. Report it immediately and protect yourself. I produce this content because volatile market setups demand analysis rooted in documented data rather than emotion. This is financial warfare education, not financial guidance. Confirm every assertion through primary sources. Make your own choices based on your own situation. Now let me walk you through the 5 specific elements converging on Friday that generate explosive potential. Factor 1, the options. Expiration cascade. Friday, February 21st, marks the expiration of weekly silver options. Contracts on COMEX. These aren't the major monthly expirations, but weekly options produce their own volatility dynamics through a process known as gamma exposure unwinding. Market makers who issued these options hedge their exposure by purchasing or selling futures. As options near expiration, hedging demands shift rapidly depending on where the price sits relative to strike prices. Here's why this is critical for Friday specifically. Open interest is heavily clustered at the $75, $77.50, $80, and $82.50 strike prices for both calls and puts. Silver currently trades at roughly $78, positioned directly between major strike groupings. Market makers are presently hedged for price remaining near $78. If price pushes convincingly toward $80 or retreats toward $75, market makers must swiftly recalibrate their hedges by buying or selling futures accordingly. This hedging activity can magnify price moves dramatically. A push toward $80 compels call sellers to purchase futures as a hedge, which lifts the price further, which necessitates additional buying. Conversely, a slide toward $75 compels put sellers to offload futures, which drives the price lower, which necessitates further selling. The options expiration generates mechanical feedback loops that convert modest directional shifts into violent accelerations. The setup for Friday reveals substantial call open interest at the $80 and $82.50 strikes. If silver pierces $80 during Friday's session, gamma hedging flows could propel price toward $82.50 or beyond in a rapid surge. On the flip side, meaningful put open interest at $75 and $77.50 creates downside acceleration risk if price slips below $77. Factor 2, Friday positioning before first notice day. March. First notice day is now 6 days out, landing Thursday, February 27th. However, Friday represents the last complete trading session before the compressed final week preceding first notice. Major institutional traders needing to reconfigure positions before delivery mechanics kick in will make those adjustments Friday, rather than waiting for the abbreviated final week. The commitment of traders, data publishing. Friday afternoon will reflect positioning through Tuesday's close, but Friday's actual trading will capture final pre-delivery week realignments. Traders planning to stand for delivery need their positions locked in. Traders seeking to sidestep delivery must roll forward or exit. Traders aiming to pressure the shorts need their firepower ready. This Friday positioning dynamic has historically produced above-average volatility in the final sessions ahead of major delivery windows. March 2026 represents the largest silver delivery month in recent memory given current open interest levels and physical supply limitations. The positioning stakes surpass normal levels, and Friday is the last convenient window for adjustments. Factor 3, COMEX Vault data timing. Friday morning's Vault report will disclose Thursday's inventory movements. The market has watched in disbelief as 15 million ounces departed registered vaults this week alone. Thursday's preliminary figures suggested another 2.9 million ounce drop. If Friday's report validates that number or reveals quickening withdrawals, the market will head into the weekend knowing registered inventory has potentially slipped below 91 million ounces. That figure carries psychological weight. The 90 million ounce mark represents the lowest registered inventory level since 2019. Breaching it. Friday morning would activate algorithmic buying programs coded to accumulate on inventory breakdowns. It would spark headlines and social media buzz that attracts fresh purchasing interest. It would signal that the depletion is picking up speed rather than leveling off. Alternatively, if Friday's report shows a halt in outflows or even net additions, it would arm bears with evidence that the squeeze thesis is faltering. Short sellers would grow bolder, adding positions. Long holders might book gains. The directional reading of Friday's Vault data will heavily shape the session's trajectory. The Vault report publishes at roughly 4 p.m. Eastern Thursday, meaning Friday's trading session is the first chance for the market to fully process and respond to Thursday's shifts. This generates information-driven volatility at Friday's open. Factor 4. The geopolitical powder keg. The Iran situation has worsened considerably throughout this week with no resolution visible. Over 50 fighter jets deployed to the Middle East, partial Strait of Hormuz closure for naval maneuvers, hostile statements from both sides. Vice President Vance indicating Iran is unwilling to recognize the administration's red lines on nuclear matters. Friday carries heightened risk of weekend military operations. Historically, military strikes are frequently initiated over weekends when markets are shuttered and immediate financial fallout is postponed. This produces a dynamic where traders must decide Friday whether to maintain positions through possible weekend escalation or parry exposure to dodge gap risk. The decision math tilts toward reducing short positions and building long positions. Nobody wants to be short silver heading into a weekend when Iranian military installations might be targeted Saturday morning. The lopsided nature of weekend risk generates buying pressure Friday as traders hedge against geopolitical eruption. Any escalatory headline Friday during market hours would spark immediate safe haven purchasing in precious metals. Silver would surge violently as algorithms run programmed responses to military-related terminology. The Iran situation converts Friday from routine trading into a session where a single headline could swing prices 3 to 5% within minutes. Factor 5. Chinese market. Full reopening. The Lunar New Year holiday period formally concludes with Chinese markets returning to complete participation Friday and into the weekend. Chinese industrial purchasers, investment funds, and trading operations that functioned at diminished capacity throughout the holiday week will resume full operations. Chinese silver appetite has been voracious throughout 2025 and 2026. January imports topped 700 tons, an annualized rate of 270 million ounces. The Shanghai premium of $54 above a Western paper reflects authentic industrial demand prepared to pay any price to obtain physical supply. When Chinese buying force returns at peak strength, it collides with Western markets already buckling under delivery strain. The timing is especially notable because Chinese traders will observe the same data as everyone else. They'll see COMEX registered at 91 million ounces or less. They'll see March open interest at 389 million ounces. They'll see their own market in backwardation with zero delivery allocation for speculators. Chinese institutional traders are shrewd. They grasp squeeze dynamics. Their return at full capacity injects buying power into an already constrained marketplace. How these 5 factors interact. Now, let me explain how these elements combine to produce explosive potential. The options expiration generates mechanical feedback loops, amplifying directional moves. The pre-delivery positioning creates urgency to finalize positions. The Vault data supplies fundamental validation of physical shortage. The geopolitical landscape adds safe haven demand and headline risk. The Chinese reopening contributes buying power. If Friday opens with bullish Vault data confirming continued drainage, Chinese buyers returning forcefully, and a stable geopolitical backdrop, the combined impact could drive silver through $80, igniting gamma acceleration toward $82 or higher. This scenario could see silver finish Friday 5 to 8% above current levels. If Friday opens with bearish Vault data showing a drainage pause, profit taking from recent gains, and any de-escalatory geopolitical developments, the combined impact could push silver below $70 suspended dollars, triggering gamma acceleration towards $75 or lower. This scenario could see silver finish Friday 3 to 5% below current levels. If Friday witnesses geopolitical escalation through actual military action or a credible threat, safe haven buying would overpower all other dynamics. Silver could leap 10% or more within hours, irrespective of options mechanics or positioning considerations. This scenario would be catastrophic for exposed shorts. The unifying thread across all scenarios is extreme movement. Friday is unlikely to be a placid consolidation session. The convergence of factors creates stored energy that will discharge in one direction or the other. Here's the data snapshot creating Friday's volatile setup. COMEX registered inventory at 93.9 million ounces, potentially falling below 91 million. In Friday's report, March open interest at 389 million ounces, with first notice day 6 days away. Coverage ratio at 4.1 to 1 and worsening. Weekly options. Expiration with dense strike concentration at $75, $77 or $50, $80, and $82.50. Shanghai premium at $54 with backwardation signaling urgent physical demand. Over 50 U.S. fighter jets stationed in the Middle East, with Iranian naval exercises ongoing. Chinese markets resuming full operations after Lunar New Year. U.S. Mint suspended through March 15th. Royal Canadian Mint sold out with no timeline for restocking. Every single data point suggests heightened volatility potential. The directional outcome remains uncertain, but the scale of potential movement is historically extreme. Let me specify exactly what to monitor. Friday morning to gauge which scenario is materializing. Watch the pre-market GlobeX session from 6:30 p.m. Thursday through Friday morning. If silver holds above $77.50 overnight and exhibits buying interest towards $79, bulls have overnight command. If silver falls below $77 overnight, bears are pressing, and downside acceleration becomes plausible. Watch the COMEX Vault report when it refreshes Friday morning around 8 Gazo to AM Eastern. Thursday's withdrawal figure will establish the tone. A number exceeding 2 million ounces confirms quickening depletion. A number below 1 million ounces hints at stabilization. Watch Shanghai pricing during Asian hours Thursday night into Friday morning. If the Shanghai premium remains above $50 or expands further, physical demand stays unquenchable. If the premium contracts toward $40, some strain is easing. Watch geopolitical news feeds closely. Any report regarding Iranian military action, Strait of Hormuz disruption, or diplomatic progress would instantly affect silver prices. Friday's trajectory could be dictated entirely by a single headline. Watch the $80 level with intense focus. This is the gamma trigger for upside acceleration. A sustained breach above $80 early Friday activates mechanical buying flows that could extend gains swiftly. Conversely, watch $77 as the gamma trigger for downside acceleration. Here's what you should do this evening to ready yourself for Friday's volatile potential. First, establish your risk parameters precisely. Calculate the dollar effect of a 5% swing in either direction on your current holdings. If that figure exceeds your comfort threshold, consider resizing positions before Friday's session rather than amid the turbulence. Second, configure price alerts at pivotal levels. $77 is the downside danger zone. $80 is the upside breakout mark. $82.50 is the gamma acceleration target. $75 is the downside acceleration target. Know instantly when these levels are tested rather than learning about the move after it's occurred. Third, settle on your Friday approach in advance. Will you trade the directional breakout? Will you step aside and let the volatility play out? Will you employ options to cap risk while capturing potential upside? There's no universally correct answer. The right answer hinges on your risk appetite and conviction level, but having no plan whatsoever is the worst possible stance. Fourth, prepare for weekend holding decisions. Friday's close determines your exposure through the weekend. If Friday ends with strong gains, do you carry into a potential weekend gap higher? If Friday ends with notable losses, do you carry into a potential weekend gap lower? The geopolitical situation creates asymmetric weekend risk, demanding a conscious choice rather than passive inaction. Fifth, verify primary sources. Friday morning, before executing any decisions, check the Vault report, check Shanghai pricing, check overnight futures levels, check news feeds for geopolitical shifts. Don't trade based on social media chatter or secondhand accounts. Go to primary sources and confirm actual data. Silver closes above $82. Probability, 15%. This requires a geopolitical escalation headline or dramatic Vault data coupled with gamma acceleration through $80 strikes. Silver closes between $80 and $82. Probability, 25%. This requires sustained bullish momentum, favorable Vault data, and no bearish disruptions. Represents a successful breakout above resistance. Silver closes between $78 and $80. Probability, 30%. This represents consolidation near present levels with elevated volatility, but no conclusive breakout in either direction. Silver closes between $75 and $70. Probability, 20%. This requires bearish Vault data, profit-taking, or mild de-escalation headlines. Represents a pullback within the broader uptrend. Silver closes below $75. Probability, 10%. This requires a substantially bearish catalyst, such as a major de-escalation announcement or unexpected inventory inflows, would constitute a technical breakdown. The probability distribution reveals a 40% chance of closing above $80 versus a 30% chance of closing below $78. The tilt favors the upside, but meaningful downside risk persists. The crucial takeaway is that a calm close between $77 and $79 with minimal turbulence carries only about 30% probability. A 70% likelihood exists for swings exceeding $2 in either direction. Friday will probably be explosive regardless of which direction prevails. 6 days until first notice day. 93.9 million registered ounces against 389 million paper claims. 15 million ounces drained this week. Shanghai premium at $54. Options. Expiration Friday with heavy strike clustering. Geopolitical tinderbox with weekend escalation risk. Chinese markets returning at full strength. The setup is documented. The factors are converging. The volatility is coming. Prepare tonight. Execute tomorrow. Don't enter Friday's session without a strategy and without grasping the explosive potential the data reveals. This is financial warfare education. Friday will distinguish the prepared from the caught off guard. Rest lightly tonight. Tomorrow's opening bell launches the battle.